So this is going to be a huge wake-up call for everyone watching because you guys need to pay attention. Interest rates are likely not going down the same way you think they are. We're not going to get the 1%, the 2% interest rates that you're used to seeing in 2020, 2021, 2022. Those days are long over. So you need to make smart decisions. And Rel, let's show them exactly why we're saying what we are right now, bro.
Yes, most definitely, bro. And like Newski said, it's a wake up call, y'all, because as they say here in this tweet, shout out to Kobe C. Letter, he said there seems to be a view that once inflation hits 2%, once we finally get it down to 2%, interest rates are going to go back to historic lows. And that's just not really true. You can literally look at what the market is pricing in, right? These interest rate markets are pricing in that the Fed funds rate will bottom at 4% in 2025. So the federal funds rate, the rate that the Federal Reserve is setting for interest rates across different industries, they're saying that it is going to be 4% at the end of 2025. And then they're going to start rising again. So it's not even like it's like it's going to be at 4%. And then maybe in 2026, it'll start to see 3%, 2%. Like, no, that's the lowest. And then it's going to go up again, and it's not even just a US thing. As the tweet says, the same can be seen in Europe, where rates are expected to bottom at 3%. So it really just seems as if this higher rates for longer thing is the new normality. Like, this is really what it's going to be forever on. It's like COVID changed the world. It changed the scope of everything financially. And so that era of free money is absolutely over. And that was the gist of this tweet. And this is the wake-up call that we all need to be aware of right now.
Yeah, and the crazy part is, guys, like when you think about this, right, it's basically saying the Fed fund. So people who don't know, Fed fund rate is a lot different than the mortgage rate or the credit card rate or the interest loan that you get on your student loans or whatever it is, right? Like when you guys think about it, if the Fed fund rate right now is between 5.25 and 5.5%, it's like, think about it. The mortgage rates, if you have good credit score, is like 7.5, and that's great if you have a great credit score. But you're north of 8%, you're north of even 8.5%. The loans that you're getting on cars are north of 12%. So there's a huge difference. Just because the Fed is saying that 4% is what they will make their rate does not mean we're going to see mortgage rates at 4%. Most likely, you're going to see mortgage rates at 6%, and that's if you have great credit score. So that's something you have to be very careful of. And this is just a tweet, bro. So let's go over another article. I'm going to take the screen from you really quick, bro.
Yeah, no, it's definitely. And even more specifically on the federal funds rate, just to say, it's like, it's the rate that the Federal Reserve is setting for banks who lend to banks, because there's overnight lending between banks, and that's all the federal funds rate is. When banks lend to banks, they have a set rate that they have to follow, set by the Federal Reserve. But that doesn't mean, like you said, that's not your mortgage rate. Your mortgage rate is actually higher than that. For
a lot, because think about it, the banks have to make money too. So that's what they're getting from the Fed, but then they have to make money on top of that. So just think about it, right? That tweet came out, but in September 20th, 2023, this article came out by CNBC. It's basically talking about Fed declines to hike, but points to rates staying higher for a longer period. And I don't think this got too much attention, but if you scroll down, right, we're going to put all of this in the description below so you guys can read along. But there's a couple of things that I really, really wanted to point out. Now, when you think about it, it says that projections right here, projections released in the Fed's dot plot show the likelihood of one more increase this year. So they're talking about one more increase in 2023 of the rate, the 2 cuts in 2024, 2 fewer than what was indicated during the last update in June. So this would say that would put the Fed's fund rate around 5.1%. And then they got into a little bit more detail and like what projections would look like. But it says the projections for the Fed fund rate also moved higher for 2025 with the medium outlook at 3.9% compared to 3.4% previously, which is basically what Rel just talked about in his tweet. But sometimes we'd be like, oh, is this tweet really credible? It actually is, based on what the data is saying, based on what the Fed is saying, based on what the participants who make up the rate are saying. So this is not something to be like, oh, this is great, right? It's going to go down. Maybe it's going to go down, just a random tweet. It's not a random tweet whatsoever. Now, Rel, let's just think about this really quick, bro. So why would they even decrease the rates? Like, is there any reason to decrease the rates?
The only time they would really need to decrease rates is if they need to stimulate the economy again. because we may be in a recessionary state. But to be honest, the way that things are moving, consumers have been spending and unemployment is at almost all-time lows at this point. So people have jobs, everything is going smooth in the economy. So there's no real reason for them to cut rates. Like, why? Because the thing is, if they were to cut rates, they're going to now overstimulate an economy that's already booming. And what does that mean? Inflation spikes. And then we got it 2022 all over again. Then they're going to have to raise it again to get inflation down, and you got a never-ending cycle.
And I think that's the cool part what you just talked about, right? When you guys think about it, bro, it's the fact that inflation is a concern. However, people are paying off their credit card debts. People are not too delinquent on their mortgage payments. Student loan payments are coming out. Yeah, so we'll see how that transpires and goes about as we get more detail. But car payments, they're starting to get more delinquent, right? People are complaining about it. But overall, as an economy, we're doing pretty decent. I know it's strange to think about, but why would they decrease rates if we're doing fine? They really wouldn't. They might decrease it a little bit, but they don't want inflation to go right back up. So now this impacts real estate because it's like, yo, we keep on talking about it. You guys are waiting to get on a house just because you think interest rates are going to go back to 2% again. You're going to be waiting for quite some time, and the housing price is just going to go higher and higher and higher and higher. So that's one. Then if you think about small businesses, bro, and corporations, as a business owner, bro, are you taking out loans if you continue to see that rates are so high?
Bro, it's going to slow all of that down.
Exactly. So my opinion is the economy probably won't be doing the best in the next 2-3 years because of this, right? They're going to have to adjust. And that's where AI comes in. It's like, is this going to help? Are we going to continue seeing job cuts? Because the more rates go up, the more harder it is to actually stay afloat. So you have to fire more people and now rely on AI. So there's a lot that goes into this, bro. There's a lot. It's kind of scary. But I want to show one more thing with the actual projection. So pull that up for me really quick.
Oh yeah, for sure. Let's definitely show them. So basically, guys, there's a tool you can use called the See Me Fed Watch tool, and it shows you there's Fed Fund futures traders who are basically trading on the anticipated federal fund rate, that same rate we were talking about that the Federal Reserve sets on interest rates. And what this is saying is they're pricing in, and this is what we mean when we say, yo, the market has priced in the interest rate. The market is pricing in, they're going to cut it in June, they're going to cut it in May. They're referring to this tool. This is an official tool. And so if you actually look at what's projected for the latest month that can be shown right now, which is December 2024, this is what's being said. So for context, right now, the current federal funds rate is between 5.25% and 5.5%. Okay. And they're saying that December of next year, so over a year from now, you can kind of take an average of these three percentages.
I would say it's fair to say between 4.25 all the way to 5. That's like the most accurate. And I would say smack in the middle, 4.5 to 4.75 is what they're most likely going to be at.
Yeah, I agree. And I mean, that is the highest percentage anyways. 27% is the highest percentage. Even it's a little scattered here, but the majority kind of circles around, like you said, between 4.25 to 5 and to 5%. And so that kind of shows you in itself, like, yo, I think by the time next year come around, it's like they're gonna be cutting rates so hard you get back to COVID rates. So you waiting to buy a house, you probably spending irresponsibly on your credit card because you expect lower rates going forward and this and that. Yo, guys, it's not happening. It's not even being priced in. And like the tweet that we talked about at the beginning of the episode said, it's like, yo, markets are pricing in permanently higher rates. All right. So this higher rate is the new normal, and that era of free money is over. Over, y'all.
Yep. And it's scary because when you guys think about it, man, I know a lot of people are making decisions based on low interest rates that you thought we were going to get, but we're not. So that's why we want to make an episode for you guys that this is your wake up call. You guys have to start making smart decisions. You should always be making smart decisions, but this is even more of a wake up call than before. But let us know what you think. You guys think this is just a game? You guys think that we will go lower? You think this is the bluff? Like, we don't know yet. So we want to know your opinions as well. So comment below, share this with people who you want them to realize what's happening, and like the video as well. But the most important thing you gotta do is subscribe to the channel and hit that little notification bell because we drop
2 videos a week.
And you do not want to miss it. Once again, let us know what you think. But check us out on Wednesday. Until then, peace.
Peace.
Soundstripe.